Okay, that's a photo finish. The bell goes off. Let's take a look at how we're starting this Friday morning. Starting a little cautious, 30 points lower, 27 points lower. But like I said, it's not too bad considering the market defended critical levels yesterday thanks to that short covering bounce. The Bank Nifty is already flashing a little bit of green. The mid-cap index is very quiet at this point, 0.2% lower. The Nifty is just, around that pivot, 30 to 35 points lower. That's what we have. Let's get the stocks board up just to get an at-a-glance view. It's still more declining stocks than rising stocks. I mean, that's something you have to give. But it's not too bad. Bharti Airtel is the one in focus. Rima has been telling us about the prospects of a large trade that we're expecting in which perhaps the promoters are going to offload some equity. That stock's down about 2%. There's some more weakness in banks and IT. It happened now. 1% equity exchange. Stocks lower about 3%.
It's a large size, right? Like 9,000 crore plus in terms of the total exchange. And that's weighing on the stock. And as I said, this is the third consecutive time, the third time that they've done in about 1.5 years. So who knows if more is coming. But that's Bharti Airtel. That's the top loser. Other losers include HDFC Bank. So that's dragging the banking pack overall. Axis Bank is open in the red. Eternal has a cut of about 1%. Hindalco, Sun Pharma, Shriram Finance are a couple of the other heavyweights with a red tick. On the way up, some of yesterday's losses. Nestle is higher in trade, but it's still very, very quiet. I think all the action is in individual stocks, where an AU, LIC, Max Financial, Nigel, these are the ones all reacting.
Well, that's right. Actually, AU Small Finance, from the first tick, it's seen a sharp downtick, actually. It's up only around 3% or thereabouts right now. The news is positive, but there is some selling from the top. As is the case with Kalyan Jewellers, it was up more than 3% in pre-open. That is up only 1% right now. So some of those good numbers, they opened in the green, but they've come off a little bit. A good news flow as well with regard to AU Small Finance Bank. Best Agro, that's one stock that's selling off. So a big downtick on both those two names. Not sure what's gone on there. But on the flip side, you've got some, I think, favorable reactions as well. You have KRBL. Stock is moving higher on very, very large volumes. So just pull up that stock out there. Good move is what we're seeing. LIC as well is doing quite well. You should pull up that stock as well. LIC. KRBL is flying away. That's up close to on 10%. LIC, one of those underperformers post its IPO. That one as well has found its way back. And you have Kalpataru Projects. That stock, in fact, is doing well, up more than 5%. But GSFC, that's another one that's moving higher on very, very large volumes. So keep an eye. Comes in at around 24,635 ballpark.
Absolutely. I've got some more stocks, just spotting them on the screen right now. Look at Coforge.
Yeah.
Pretty weak start for Coforge, almost 4% lower. We'll dig a little deeper into this. There's Page Industries that reported numbers yesterday. Not getting the kind of follow-through, 3% lower on Page. Data Patterns is yet another company. Revenue's down some 75%. Margins have fallen about 500 odd basis points. Stocks down 5%. So that's what we are getting. There's some selling in Shakti Pumps. It had rallied, of course, earlier. But today it's opened down. Bharti, even Hexacom is lower, actually, not just Bharti Airtel. Hexacom is also down. Blue Star is losing some more ground, 2% lower. So these are stocks on the lower side. But then on the flip side, PVR Inox, I'm not sure if we have an interesting release today or not, but a nice Friday flavor with PVR. There's Ujjivan Small Finance Bank. Some of the smaller financial names, watch for them. There's a AU rub-off effect as the market, picks up hope that maybe the others will eventually also get their universal bank licenses. So Ujjivan is an interesting one to look at. From the insurance space, GIC, the reinsurer, 6% up on GIC. So on the heels of LIC itself is up 4.5%, GIC is up 5.5%, and even Max Financial, 3.5% higher. So, yeah.
So that's, one of the factors behind the stock that's up close to about 3.5%. Vishal Mega Mart, one of the stocks which is going to get impacted by MSCI, that has opened with a cut of about 1.25%. Biocon, numbers have missed expectations. Generics was weak. The generics growth was just about 5.5% on a year-on-year basis, lower than estimates, and that stock has taken a bit of a knock. One of the new listings, Sri Lotus Developers, it had a blockbuster listing, but today it's given up some of those gains, and stock is down close to about 0.5%. KRBL is an earnings reaction. Kalpataru Project is an earnings reaction. These two stocks are moving up on very, very large volumes.
I think NSDL, Rima, talking about new listing, just take a look at that. First day it was up 10%. Some were disappointed. Then yesterday it had a 20% move, and today it's up another 10%. But, the stock is up 10%. So in this, from the listing price, I think it's up, what, 50%, I think so.
800 was the issue price.
Right?
800 was the issue price, 41% subscription. But just the kind of money, right? DIIs yesterday bought more than 10,000 crore rupees. And these are large IPOs. JSW Cement is open.
Yes.
Knowledge Realty Trust got the highest ever subscription for a REIT. NSDL saw such strong subscription.
Yes.
And yet, when primary market is sucking out so much money with 1,000 crores, that's the power of retail.
I'll tell you what, let's get to a couple of those big numbers. LIC is buzzing on good earnings. Vamakshi joins us to help us recap those numbers. Vama.
Well, absolutely, Nigel. A fabulous set of numbers coming in from LIC, and you're seeing how the stock is reacting in trade today, up almost 4.5%. The new business premium was up almost 5% at 60,262 crores. This has come in higher than what the street was anticipating. Apart from that, went down. It's a slight miss, but nevertheless, it has come in at 12,652 crores, and this growth is largely being driven by the retail APE, which again has come in better than what we were penciling in. Now, the value of new business, which is the VNB, also saw a good uptick of almost 21%. This has come in higher than what we were expecting, and that bodes well for the company, because the VNB margin as well, seeing an improvement of around 150 basis points. The VNB margin now stands at 15.37% and has come in higher than what we were expecting. So overall, a good set of numbers coming in from LIC, the stock reacting to those as well. Absolutely,
it is. It's surging away 4.5%. This morning. Thank you, Vamakshi, for joining in with that quick recap of the LIC. This is with us. Krishna, great to have you on. Thanks for joining in. So many headlines, so many moving parts, geopolitics, tariffs and whatnot to digest. And then, of course, earnings. Not easy to make money in this market anymore, right? So what's your recipe or what's your, what's your formulation for making money for the rest of the year? Because it's down to very, very specific stocks now.
Yeah, I agree. It's stock specific, but I think the broad recipe is simple. Can we avoid the noise and look at next 18 months, 24 months, which is typically the the investment time frame? We look for companies, and to that extent, once you go ahead, some of this noise and atmosphere, 6.5, honestly, is not something we should be worried about. It's a nice growth in the overall context of the world. So that's a real recipe. Keep your time frame right, which is essentially maybe 18 months, maybe 24 months from now, when some of this noise will go away, earnings will keep on coming. Noise are maybe detracting the valuations right now. So hopefully the combination of earnings and multiples will support the investment hypothesis.
Looking inwards, and we've been seeing this K-shaped recovery for a while now, Krishna. So what are the subsectors within consumer discretionary or staples which look attractive to you over the next 12 to 24 months?
Yeah, this K-shape clearly has supported higher end consumption, within which something like travel and leisure can be one nice spot. Maybe upper end discretionary products, maybe durables, maybe automobiles. I think those are the typical beneficiary of high end consumption, and we do believe that stays good. At the same time, let's look at the other side of K-shape. We believe things have improved substantially over last 12 months into that segment of economy, and going ahead, even we expect on business performance front, because staples is a place where now the rural economy is picked up far better than what it was 1 year back. So something like that is going to help consumption pattern even in the other side of K-curve.
All right, just hold on to that thought. Now, just keep an eye on Divi's Laboratory. The stock is lower. Overnight we had Eli Lilly's experimental oral weight loss drug. Out there, the average loss was around 12.7%, which is a little lower than the 15%. Now, the street believed that if this drug did well, it would be a potential opportunity for Divi's in the time to come. So, may not be as big as what was estimated. So, I think that's why a bit of a sentimental knockback with regard to this stock, because of Eli Lilly's oral weight loss drug wasn't, as successful as what earlier expected. So let's see how degrowth higher than expected. That's why that stock is under some pressure in today's trade. But let's get back to our chat with Krishna. Krishna, I wanted to ask you about the real estate space. We were just highlighting some IPOs, and in Lotus, I saw that y'all were one of the anchor investors.
Yeah, let's look at real estate. And if I go back to the previous question, that's clearly one more name on the discretionary consumption space, especially higher end. So real estate is one more discretionary space, and yeah, we do own quite a few stocks across, in terms of real estate there. The current market, honestly, is slightly challenging. It's not that it's not there. It's just that, there are certain pockets which are value, unfortunately, not able to spot a catalyst for a quick, realization or monetizing that value. That's where the idea is, again, to keep slightly more longer term focus. That 18-month, honestly, to my mind, 12 months old, this roughly 25,000 Nifty is what we were a year back. Today we are. So in a way, value is emerging partly from, time correction. At the same time, we need little bit more earning support, and that's where, value, I think, is little bit one has to wait for that value to be monetized rather than upfront. Other side of the market, clearly slightly more momentum.
Estate, you're positive, right? I mean, when I asked you about Lotus and the money you'll put there, real estate is one of the sectors you're positive on?
Yeah. As I said, real estate is one of those, discretionary, K-shaped beneficiary of India is earning more, Indians are spending more. It's maybe combination of lifestyle as well as, earning growth combination.
Okay, all right, Krishna. Appreciate you stopping by and giving us those, your take on the markets. For the time being, the markets have moved to the low point of the day. We're down close to 60 points. Till yesterday's close protected, I don't think the street will be too worried about. But I'll tell you what, a couple of these good numbers are getting sold into. And Kalyan Jewellers, just take a look at that stock. It's corrected close to 8% from the high point of the day. AU small the last time.
But NSDL has gotten stronger.
Yes.
I think it was up 10% when you spotted, now up 15%.
Yeah, I think that the float factor as well will play a role out there because, those that took in the pre-IPO, I don't think they can sell, and the float as is will be limited. But that's a 50% return from its IPO price.
The SC is also slipped, by the way.
All the good earnings.
All the good, where it wasn't a blockbuster, but good numbers.
Yeah.
But it also tells you something about the market's mood and overall sentiment, right? Till this is resolved, this whole 50% business. Because wherever there is a pop, people are rushing in today to take profits. That's the psyche of the market. Look at the mid-cap. So yeah, it's still weighing on sentiment till we have some more clarity. All
right, let's focus on Uno Minda. We have Sunil Bora, the group CFO of the company, who joins us on the show. Hi, Sunil. Good morning. Good to have you as always. Before we get to your numbers, let's talk about the crucial issues. Trump's tariffs, how are they impacting business? Have you got some feedback from customers? I think 11% of your total mix comes in from international market. How much of it is from the United States? And have you received feedback from your customers?
Absolutely. So in terms of the exposure to US of our total revenues, it is less than 2% as we speak. So definitely it's not a significant quantum if we look at the top line perspective. And also you asked in terms of customer feedback. So definitely customers so far have been very positive in terms of the total revenues. In fact, ours will eventually pan out because the businesses cycle we are in, it is, auto industry is something where when you have to get into a business, it's a long cycle. And I'm sure at the same time when you have to sort of replace your suppliers. So it's not something which you can switch on and switch off overnight because there's a long time to develop the product and then get into a new model launch, and then you are part of that entire life cycle. So from that perspective, I think from auto perspective, specifically from tier 1 perspective, it's very difficult to say what will be the immediate impact. As
exports as a percentage of your total top line annual revenue, what would that number be?
Yeah, so that's what you just said. It is roughly around 11%. And when you say
11%,
it is export plus our international revenues. So we have some assembly operations or manufacturing operations outside of India. So as an overall pie, it is roughly around 11% of our...
11%, got it. So now, given that there are, and we'll see if we settle at 25% tariff, but it seems that 15% between the EU and US, etc., those things seem to be fairly settled. And the ASEAN tariffs, they seem to have settled. There's no further negotiation there. So because of all of this, can you give us some more perspective on what you're expecting from your overall international business, exports plus international? Are you getting more inquiries? Will you have to make any kind of shifts in terms of, the areas you're manufacturing at?
No, absolutely. Actually, our exports are actually doing, if you see in absolute terms, doing much better than what they were on a year-to-year or quarter-to-quarter basis. In fact, at ASEAN, if you remember, last year we commissioned a new plant in Vietnam. As we speak, the business is stable. And there are some exports which are happening from India to Europe, ASEAN, and to US. And as I said, US is definitely a very small number, and there is not much of export from other geographies to US. So from that perspective, we are quite insulated.
It's not a big impact, 2%, but you still don't want to lose 2% also, right, Sunil, of your overall revenue?
That's what I said. So as I said, as of now, our numbers are actually looking better than what they were. And when you see auto tier one, it is not something which I'm maybe repeating, switch on, switch off to one supplier to other supplier. It's a long cycle. So even if the customers, for a moment, if we think has to maybe look for some other source, it's a long cycle. And
Yeah.
today things are
But if,
so volatile.
assuming you have the order, Sunil, there could be some margin pressure. It's ultimately a very large tariff burden to be shared by one entity. To be taken up by one entity, it will have to be shared. So in that context, do you see any kind of margin pressure? Because you reported margins ex incentive.
So, as I said, it's little early to comment on the cost pressures. Our numbers are actually better. And to whatever indications we have, our customers as of now have not even sort of came up and say, how can we sort of share this? So, because I think they are also in the process of digesting the impact and how this can be sort of panned forward. And they will, I'm sure, also look at other options. So it is not that only India is impacted. There are other geographies also. There is a tariff. Yes, there might be a differential, which we all know will kick in from 27th of August. But still, I think there is some optimism that something might come out of this discussion.
Okay. What is your content per vehicle for ICE?
Referring to a PV or a two-wheeler?
Two-wheeler.
So two-wheeler is IC content is same. We have not added any significant number. So we disclose the numbers on annual basis. So the number which we declared in the last quarter remains the same.
Got it.
Let's talk overall growth and margins as well, Sunil. So in the first quarter, you've done about 16% consolidated top-line growth. Margin is at about 10.7%. What's the outlook in terms of how pricing is moving in the domestic market and, of course, raw material and costs, etc.? What can you tell us about the future of margins for the
basis points? And we are within that guidance range on an annual basis. So quarter to quarter is very difficult to comment on. That's why we give a annual margin, because normally whatever price discussions, etc., are happening with the customers, normally they get close towards Q3 and Q4. And that's why if we see our trend for many years, normally Q3, Q4 tend to be a little better than Q1, Q2. And that's why on an annualized basis, it is 11% plus minus 50 basis points. In terms of cost pressures, as you know that large part of our commodity businesses, commodity cost is actually passed through to our customers. It's upcycle also is shared with the customers, and even downcycle we don't stand to gain anything. So from that perspective, we are trying to insulate the business as much as possible from the commodity price volatility.
Steady. What about the growth in the India business? So total top line visibility, can you share some sort of a guidance for us for the full year?
Yeah, so absolutely. As you would have seen in past also, we have been very clear. We never give a headline number in terms of revenue, because we are completely dependent on our customers. So we have been consistently saying whatever market grows, we grow at least 1.5 times of the market growth. And if you see even the last quarter, the large part of the business, which is our 92% of the business from two-wheeler and pass car 16%. So that clearly demonstrates the outperformance. And if you plot that for past many quarters, many years, I think we've been consistently outperforming the industry growth, and we're quite optimistic we should be able to continue that in the near future as well.
Okay, all right, Sunil, we'll leave it on that note. Thank you for joining in today. Good luck for the rest of the year, and we look forward to more conversations in the future. I have to take a quick break. The market, Nifty is down about 80 points as we speak. The mid-cap now, Mr. Ashok Sonthalia will join in. of earnings to go over. And another good set that came in was from actually Titan. In fact, if we talk about the Q1 performance, it was a pretty decent quarter. Margins have been looking stellar. And the watch business is also growing. In fact, if you talk about the overall revenue, then an increase of about 21%. EBITDA margins at a 34.8% coming in, improvement in the gross margins as well. We have Mr. Ashok Santhalia, Chief Financial Officer at the company. Now that we're entering festive season, we were just discussing this, right? It starts off with Raksha Bandhan, then Ganesh Chaturthi, and then the full-blown season. What's your sense of demand, sir? I mean, let's talk pure jewelry business. What are you gearing up for as we enter the festive phase?
So of course, Surabhi, we are quite excited and looking forward to it, but we cannot ignore the kind of volatility which gold prices are exhibiting, and if you have picked up today's news again, happening, and which keeps buyer growth for gold jewelry under check. They are quite flattish, and that's a little bit concerning for us, that while we are doing everything to experiment with 18 karat, 14 karat, and CaratLane even doing 9 karat gold to keep the price point for end consumer environment, keeps consumer sentiment.
No, sir, could you complete that point? Are you saying that demand is subdued so far in the second quarter? Are you expecting it to be a slightly more subdued season then, because of the volatility? And you're saying you're doing everything. You're experimenting with even 14 karat, etc. But are those experiments working?
So of course, through like buyer number also to grow, which is not happening, which is happening in the studded. And July month, because we had our diamond festival started early. So July month has been doing well as far as diamond jewelries are concerned. And to that extent, gold is still finding favor from the investment point of view and adornment point of view. But buyer growth is muted at this point.
So if I ask you, like to like, as we get into, because Q3, there's no point saying Q3 or Q2 because the season keeps moving. Yeah. As of now, the visibility that you have,
mid-teen seems to be okay. It can be slightly better. We don't know yet, but we think mid-teen should definitely be possible.
Mid-teens. Okay. What about margins? You expanded your jewelry margins to 11.5%. What led to that? And going ahead, given all that we spoke about in terms of uncertainty, what is the expectation on how margin?
Yeah, so margin performance had one-time benefit in quarter one. We called out 50 basis point, which will reverse itself in quarter two and quarter three. But as far as overall margin is concerned, our guidance on jewelry domestic business has been 11 to 11.5 for Titan standalone basis. And that guidance we are still maintaining. But at the same time, I must point out that growth, market share gain, call have to be taken. We would not hesitate in taking that. And if that means that margins slightly go, instead of 11, 10.8, that's okay.
So there could be a downward bias to your margins. Your guidance is, aspiration is 11 to 11.5%. But, given the focus
has to be taken, we will take some calls because growth is far more important at this point.
Okay. So focus on growth over margins.
All right, Mrs. Santhalia, hi, good to have you, Ben. Tell us about the acquisition of Damas. You'll have done revenues. What is the scaling up of this business, say in the next 2-3 years? Where do you see this revenue number headed? Point number one. And when you purchase the remaining 33% stake, at what valuation will it be at?
Okay, so the 67%, yes, we have purchased. And we are kind of repivoting the brand to more Arab customer-focused brand. Right now, it has both Arab as well as Southeast Asian, Indian. And kind of, so that repivoting, Nigel, for next. After that, this should grow. Currently, they have high single-digit to low double-digit growth rate in the past. But next 12 months, I see some readjustment happening. But beyond that, double-digit growth should come. UAE as a territory is doing pretty well. Saudi Arabia, where a lot of social reforms and economic developments are happening. That's the another important market for Damas to grow. Yes. And we believe double-digit growth should be coming. As far as next 33% after 4 years is concerned, it's a profitability-linked complex formula, will completely depend on performance. So at this point of time, very difficult to kind of put a number to it.
What EBITDA does it do?
Right now, it is just low single-digit number, just has positive territory. That's it.
Okay, and to double digit?
Certainly high single digit to low double digit. It's some work has to be done, Nigel, and I think we have a lot of synergy on the sourcing, merchandising, retail operations. So in a combined ecosystem between Tanishq and Damas, we see a lot of value accretion possibility.
Next 3 years, Damas could be nearly 5,000 crores of revenues with high single-digit margin. That could be the aspiration, right?
Okay. Yeah, we have not yet finally penned that down, but that seems to be very reasonable.
So your watches division margins were quite high this time, 22%. But I believe there is some one-off inventory gain. What are the adjusted margins? And do you think you can, you're given a guidance, I think, of 18 to 20% on margins for watches. Does that stay, or do you think you can push it higher?
So adjusted margin for quarter 1 for watches is about 18%. 400 basis point one-timer is there. We had guided about 12.5 to 14.5, Sonia, if you remember. But we think that FY26 will be quarter 4, because when this inventory gets consumed for sales, this kind of will hit P&L. But it's not a very, very large number, so we still mid-teen EBITDA number from watch division is certainly possible.
Okay. All right, so we'll leave it on that note for today. Thank you so much for joining in and giving us some perspective on the business, and we look forward to more conversations down the line. Well, on that, we need to see if we can protect, of course, yesterday's lows. Right now, it's a 100-point cut on the Nifty, and the mid-cap index is also down about 0.6%. So the color seems to be red this Friday morning. Rima.
All right, let's move on. We've got lots of companies to chat with. So Metro Brands, they reported a steady quarterly performance this time. Nissan Joseph, CEO at Metro Brands, is now with us on the show. Thank you very much for joining in. You've clocked in about a 9% kind of a top-line growth in the current quarter, medium to long term. For FY26, what kind of growth can we expect? And how is the consumer sentiment and the same store sales growth for you?
Yeah, I think, good morning, and thanks for having me. I think as we look forward, we see the quarter starting to maintain the momentum and maybe build a little bit towards the back end. But I think what's important to note here is if you go back to the pre-COVID 4% CAGR, if you look at that period of time, and I'm also including the COVID year in this, if you pull that out, it's definitely coming into our guidance of 15%, the mid-teen range. And I feel confident that, whether it's this quarter or next quarter, we will start getting back to that 15% gain.
Okay, 15% revenue run rate?
No, that's not what I said. I said, we will get back to that 15% CAGR growth, but we remain quite confident about what's happening with the economy, what's happening with our business. We've had 2 quarters where we've had almost double-digit growth, in an environment that hasn't been the same for a lot of our peers. So I think we'll continue that momentum trend and we'll start building back to it. We've always guided to a long-term CAGR of 15%, Nigel, and that's something we're very comfortable with.
Now, on the margin parameters, what I'm asking you.
On the profit margins, we've guided to mid-teens on the PAT margins, and our last quarter is a good example of that. We were well into the left and a little bit right as we make investments into new businesses, into marketing initiatives, into people investments. That it might do a little bit, but overall, that's what we have guided to.
How many stores are you planning to add, sir, in FY26?
So last quarter, we added 23 new stores, though we closed 3 stores. And we're starting to see momentum build up on the new store front. And we're pretty confident that we'll get back to a decent run rate. I think what's exciting in there, though, is that last quarter, we opened 4 Walkway stores. And, it's a chain that we haven't been. Last quarter, we opened 4. So we've already matched what we've done the year before. And we intend to quite grow that channel quite well as well, on top of our Metro Mochi and our Crocs. And of course, we now have the Foot Locker chain and soon to come Clarks.
Okay, all right. Give us a few more details. When does Fila break even?
Fila is breaking even. We've gone through the cleanup phase of Fila. We're now in the repositioning phase of Fila. And the only reason it may not is, we're going to distort quite a bit of our marketing investments into Fila, as you have to when you reposition a brand. It's not a cheap exercise, but it has long-term benefits to it. So, Fila, if I pulled out the marketing spends that we plan on doing, is definitely a break even already. Now, the question is, how much of the marketing spend do we do and when do you get it? And there's always a little bit of a lag, Nigel, between when you spend and when you get. So we're quite comfortable with that. And that's what I alluded to earlier. You might see our profit margin blip this way or that way, left or right of the mid-teen mark, but it would only be because we're starting to, make investments into technology or people, or more importantly, into marketing.
Interesting. Let's, Fila, we'll keep an eye out on that journey. But Fila, Foot Locker, New Era, they're still small, right, in your scheme of things. What do they contribute right now? And where do you see that number headed?
So, as you said, they're very low single-digit contribution if you add them all up together today. However, when we look to the future and we see what's happening in the athletic space, when we see what's happening in the substantial part of our revenue as they grow, albeit it'll come in stages, it's not going to be an overnight thing happening, because we don't intend to slow down the other businesses as well, right? It's not like we're stopping everything else and we're growing this. We plan on growing everything quite aggressively and quite equally.
Okay. Correct me if I'm wrong, but I think your quarterly sales per square foot has declined in Q1 by nearly 3%.
Yep, that's absolutely correct. And what you're going to see is that number is also going to blip. So, for example, the more walkway stores we open, that number is not as strong in the walkway chain as it is in a metro chain or a Croc Street chain. It is the actual sales per square foot. If you look at the top line numbers, we have been growing, so that is not a major concern on our part. But that's a number that is going to seem a little erratic from time to time, simply because it's heavily weighted towards what the stores do in terms of new stores opening and which one of our chains is having which one of our banners is having a little bit more of a accelerated growth versus the others.
So does that mean that your top line growth is largely going to be driven by an increase in the retail store addition that you do?
No.
Is that going to be the driver of growth?
I think we have a three-pronged strategy for growth. One, of course, is same-store sales growth. And as you know, the same-store sales growth for all of our industry has been a little challenging these last 2 quarters. But I must tell you, though, don't forget, we've had a 15% 12, but if you pull out the COVID year, it'd be closer to 15, right? So it's not like, and that 15 would have an element of same-store growth in there. So it's not just new stores. So it is same-store sales growth, it is new stores, and it's, of course, new banners as well.
Always a pleasure having you on the show, sir. And your first quarter, what was important was also your e-commerce business did return to the growth path. Thanks a lot for joining in. We'll track you on some of these numbers. Breakdown, or would you be brave enough and say we held yesterday's low? So maybe, in fact, go in there, buy it and put a 100-point stop loss. Or do you think we're going to break down?
Nigel, initially the idea was that I was looking to buy a 30-40 point kind of a dip, but then there was no recovery happening. And we are back to this weekly average of around 420, 25 zones. So maybe around those levels, you would want to take a long with a 50-odd point kind of a stop. I believe that that's an important level. Good chance that we could see some kind of a bounce back from there. And on the stock side, I have a buy on LIC India with a stop at 902. On the selling side is Nykaa with a stop at about 209.5, and a target of 200 is what I would look for.
BSE, Mitesh, is there any trade on BSE? Stock has slipped about 4% from highs, and this is despite seemingly good numbers.
Yeah. So there were two things. One, I think, BSE I'm watching very closely. On the last 2 occasions, if you look at the 2-hourly, 3-hourly charts, the stock made us that we will see this decline kind of accelerate and head towards levels of around 21.75. So my advice to traders, if it breaks 23.60, take a 35-point kind of a stop loss and play for another about 150, 160 points.
Kalyan Jewellers, the fall is uncanny. Look at it, 7.5% down on Kalyan Jewellers on numbers that seemed optically very good, 30% plus top-line growth, margins. At least in terms of the chart structure, at that point you were saying it was looking good, but now something's gone off. Just a quick level check again and what people should be doing, those who are holding long.
So in the morning, I said 610, 615 is the earlier high, and we could see the stock head towards that. In fact, opened around 615, and then from there has been a clear case of profit booking. It's broken a key support around these levels of 575, 570 zone. So if you are stuck, if you get a pullback to about 570, exit. Otherwise, I believe that with this kind of is where the stock had bottomed out in June.
Got that. Thank you very much for that, Mitesh. We'll reconnect. Let's move on and talk about State Bank of India. We'll be reporting numbers today. Big one. Gaurav joins in with the key expectations. Gaurav.
Well, yes, when we talk about State Bank of India, now loan book growth is expected to be in the range of around 12% on a year-on-year basis, while deposit growth may remain somewhere in the range of 10%. So definitely there are expectations that State Bank of India will actually outpace the system level growth. And as a result, when we talk about net interest income, we may see an increase of around just 1% on a year-on-year basis. And we may see a little bit of decline on a sequential basis because of the pressure on cost of funds. Now that repo rates have been are likely to remain muted. But as a result, when we talk about profit, we may see a decline of around 2% because credit cost that may inch up a little. When we talk about net interest margins, 10 basis point of fall is what the street is expecting in this quarter because of the rate cut impact. And for credit cost also, they're expecting credit cost to actually normalize somewhere in the range of 0.5%. And this is because when we look at Q1 specifically, it is usually weaker for agri segment. Talking about the other aspects, we will be watching out on how the commentary is going to be on net interest margins, because earlier management had said that they will be trying to keep net interest margins in the range of 3%. Other than that, any kind of commentary on the loan book growth is also going to be a key thing to watch out for. And any commentary on the asset quality is also something that we will be watching out on. Although the earnings season is almost over, it is very crucial as how are expected to be muted in this quarter on a year-on-year basis.
Okay, all right. Thanks a lot for that, Gaurav. We'll keep an eye out on that set of numbers. Well, for the markets, we are holding onto that cutoff around 110 points. The Nifty Bank is well 150 points lower. The breadth of the market isn't as bad, actually. You still have close to 1,000 stocks that are advancing. Well, let's focus on Crompton now. They reported a weakish set of numbers in the and head of strategy at Crompton. Hi, sir. Good morning. Good to see you in. Well, the first quarter was a little bit subdued, but are there signs of green shoots coming back now? We're close to halfway into the second quarter. Obviously, the second half of the second quarter should be far better because it'll be pre-festive. But are there signs that demand is improving and you'll return back to your growth ways?
Hey, hi. Even before looking at the second quarter, I also want to throw some color on how did the first quarter go. It's important to note that we are a company that relies on season, on categories like table rains that we had to go through. That led to drop in the business of these categories. But what is very exciting is that categories that are not impacted by that, our growth rate continues to be excellent. We doubled our solar pumps business, our small domestic appliances, which we have been consistently talking about in the last few years, continues to grow at the rate of 18-20%. We are also seeing our growth and margin improvement coming in. All in all, we see that the business is moving in the right trajectory. It's also important to equate this with market share. We have seen, in spite of impact due to unseasonal rains, market share in our core categories have also gone up, which means that the direction is right. We know that we are set for a good full year, and we can already see.
So that's the important aspect. Kaliswaran, thank you for joining us this morning. So yeah, let's put Q1 behind us. I think it was an industry-wide phenomenon. Everybody faced that pressure of the unseasonal rains. But now this is a huge business for you. I mean, it's over 1,500 crores of revenue, your electrical and consumer durables business. So what visibility do you have on the growth, on the pickup? Since the first quarter has been so bad, will the full year be flat in best case, or are you hopeful for at least some sort of a maybe single digit, if not double digit growth this year?
No, I think we are anticipating a growth in the full year, and categories that got impacted. The growth momentum in other categories is really, really good. And that should help us to recover and get back to the growth trajectory. And the anticipation is to end the year very strong and go back to a similar growth rates of last 2 years.
So what does that mean? I mean, in terms of, you could just remind us of the last 2 years of growth. And you're talking about particularly the ECD category or overall top line growth? And what can we work with?
ECD. We are expecting ECD to get back to a double-digit growth. And that's what we are looking at this point of time.
And what happens to margins for this business? Again, I'm repeating for the benefit of our viewers, ECDs, electricals and consumer durables, that is the lion's share of the business for Crompton. The margins for this segment and pricing as we get into festive season, what can you sort of guide us towards?
See, interestingly, even in Q1, if you look at it, we held down to our material margins. We took the prudent decision of not discounting significantly when the growth is impacted largely due to unseasonal rains. So that helped us to hold the material margin right. And it's the overall EBITDA margin that we delivered for last year should be there for the balance of the year.
Okay. Morning, this is Rima here. So talking about growth and looking ahead, you're also planning to get into adjacencies. I think switch gears is something that you are looking at. You're rethinking your Nirlab business because it's not provided the kind of synergies that you were hoping for. Sorry, I'm making a mistake over here. But just, I believe you are looking at some sort of, increasing the categories or trying to get into, more, segments. Could you give us an indication of that?
Yeah. See, first and foremost, we have announced already that we will get into solar rooftop. This is something that we made an announcement. Considering the kind of success that we have got in solar pumps, we think there's an opportunity to replicate the same here. And today, if you look at it, Indian homes need a brand that is trusted. And a large part of Indian household has grown with Crompton over multiple decades. And if it is going to come from the house of Crompton, a solar rooftop is something that people are really would be appreciating it and accepting it. And we think we are into our third year right now, and the business is back on growth track. Our margins are improving in Butterfly. And the new launch or the brand refresh that we did in Butterfly recently is also showing us good results. Outside this, we are also looking at few more categories. Allow me to communicate about that in detail closer to date. But yes, fundamentally what we are looking at, is there an opportunity for us to expand our total addressable market by 2 to 2.5x from where we are today. So we are looking at few large categories where we have a right to win. It's also important to note that whenever, wherever, whichever categories that we enter, we are not going to operate as one more player. Our endeavor is, can we become a top 3 player in these categories over a period of time? The success on this has been demonstrated.
Just very quickly, sorry, I'm cutting you because we're running short of time. On Butterfly, the performance has been improving, like you said. Can you give us some sense on, aspirational margins? Eventually, as things settle, at the EBIT level, not EBITDA, I have the EBIT margin number here. I think you're at about 4.2%. Where would you like to see, or where do you think Butterfly margins can settle by the end of the year?
I'll start with EBITDA first. Our EBITDA margin has been EBIT margin also. So business is going to be very, very strong performance in terms of revenue growth. And once the operating leverage kicks in, we do see that will help in expanding the EBITDA margin also. So the idea is to hit a double-digit EBITDA first and then move towards EBIT also being a double-digit.
Okay, all right. We will leave it on that note. Thank you very much for joining in, and good luck for the rest of the year as well, especially the festive season. Thanks for being with us. That's a word from Crompton coming in. We do have to take a very quick break on that. Welcome back. Let's look at the commodity markets now. Lots of headlines coming in there as well. Let's go across to Manisha. Manisha, it's Friday. What are you tracking?
Well, I'm looking at gold and it's at all-time highs, but for all wrong reasons this time around. You know, it's tariffs yet again, and that really seems to be leading to disparity now in case of gold. So when you look at the COMEX December US gold prices, they hit a record highs above 3,500. When you look at the charts, we can see those prices at 3,550 as well at one point in time. But when you look at the spot gold prices, this is where London looks at it. It is trading still at around 33.80 or thereabouts, while COMEX is now trading at 34.90. So the discount or a premium, depending on, now we are looking at 1,02,000 rupees, and this is just for 10 grams. So clearly a crore and 20 lakh rupees when you are looking to buy 1 kgs of gold there. What has happened overnight is, and markets are really reading into the fine print here, US has imposed tariffs on import of 1 kg and 100-ounce gold bars. Now, much of this import that US does comes in from Switzerland. And remember, there is a 39% tariff that you have on Switzerland right now. Now, 1 kilo gold bars are the most traded form on COMEX and is the reason that US seems to be importing record number of gold. January was such one month. Feb was okay. March again, we saw very strong imports coming in. So the first quarter of the calendar year has seen very strong imports into US. Now, from where we stand in sense of numbers is that you could be looking at an increase in sense of tariffs that the US consumers clearly will have to pay. When you look at 2024, well, the US imports gained up by almost 5%. Was the way the gold prices surged up. So 12% decline in volume, but a near 6% of gain in value is what we are seeing in gold. It has been only a day, 24 hours to be exact, that we've seen this kind of a move come in for gold. It would be interesting to see today on how London opens and then how US opens in sense of gold, and how do we really work the maths in when it comes to the global gold prices therein. But that's about gold. I also want to quickly make up at a 1-month lows right now. $65 an ounce is where we are looking at WTI crude prices trading at this point in time. And this has been a worst weekly decline pardon me, that you have seen in case of crude oil prices since the month of June. So the US and Russian presidents could be meeting in days to come, and that has taken some premium off the prices there. Interestingly, with the kind of OPEC production increase that we have seen, that seems to be weighing onto the prices too.
450, a level to watch will be yesterday's intraday low of 24,344. We're 100 points away, but that will be a key marker. Get into a break. On the other side is a special segment. Lata will speak to Mukesh Kumar Surana, former chairman, managing director of Hindustan Petroleum, to understand the dynamics of Russian crude versus US crude.
Welcome to It's the Economy. The root of India's standoff with the US is that India is buying Russian crude and thus supposedly fueling the war. That's the allegation. Now, why is India preferring Russian crude? What is the price advantage? What are the 360-degree perspective on India's crude import economy? I'm joined by the best in the business, Mr. M.K. Surana, former chairman and managing director of HPCL. Mr. Surana, good morning and thank you very much for your time. What I'm getting into is, a masterclass on how we should understand crude. So the first question really is this. How much cheaper is Russian crude? I did elementary research from that PPAF, the site you said, the Petroleum Producers Analysis Cell. It says Russia is our top supplier as of the first half of 2025.
Good morning to you, Lata, and to your viewers. If we 2%, but slowly, gradually, because of the economic advantage, because of other concerns to have the total demand-supply balance of the crude supply from Russia increased to India, and right now it will be somewhere around 35%. Initially, when the Ukraine-Russia war started, there was a reason for the suppliers to dispose of the crude which they were already having. Traders were having inventories, and there were uncertainty, and the discounts were high. But as of today, those discounts have tapered down, and this may be in the range of, on the landed cost basis, maybe around $2 to $3 to companies, considering all the things.
Okay, so about $2 to $3 cheaper per barrel for the company, for refiners as of today. That is Russian crude, right? Okay, then the next is, Russia is the most, of course, at the moment. Russia, Iraq, Saudi Arabia, UAE, US, Nigeria, Angola, Kuwait, Brazil. Now, that list gives the impression that nearer the country, cheaper the crude. Is that a good assumption?
Yes and no, because when the refiners buy the crude, it is not just the price. Each crude has got a quality, and what we term in technical terms is a gross product value of a crude. So when the refineries evaluate a crude, it is a combination of the price of the crude, the freight, insurance, plus the gross product value, better value products, and that may be preferable crude as compared to others. So ultimately, it depends on what is the gross value, and that depends on the type of the crude. Whether it is sour crude, whether it's sweet crude, whether it is heavy crude, whether it's a lighter crude, and what is the configuration of the refinery. The same crude may give different values to different refineries depending on how complexity they have built in their refinery processes.
Okay. Well, I'm sure you know the HPCL refinery best, but you would know the other BPCL, MRPL. Is sour best, sweet best, heavy best, light best? And going by that, which is the best destination source for us?
So the question is that if you see just fundamentally, theoretically, a sweet light crude will be easier to process. Okay. And that will be a preferable crude. But there is a arbitrage available, there is a price gap available between sour and sweet crude. So sour crudes are normally cheaper compared to the sweet crude. Now, over a period, Indian refineries have built in processes which can process heavy crudes, which can process differential between sweet and sour crude, and what is the processing capabilities available. But given the refinery configuration which we have and the arbitrage which is available, earlier definitely the heavier crudes were coming much more preferable for Indian refineries, heavier and sour crudes. But over a period, because of that, the demand of the heavy crude started going up, and so the arbitrage between sour and sweet crude also reduced. So it will be depending on the price to procure the crude. One more important thing will be that the refineries will have the emission norms, and the sulfur content is an important element in that. And the second thing is the end product specifications. As you know, because of the BS 3, 4, and 6 norms which we implemented, sequentially the allowable percentage of sulfur in the end products, MS and HSD, had been reduced. It has come to 10 ppm now. Oh. So we have to see what is the end product specification on sulfur and what is the boilers and furnaces. So we have also to manage that, and depending on that, the crude diet of a refinery will get decided. A part of it can also be managed by burning, let's say, natural gas in the refinery, which is lower sulfur content.
Okay. So, now to the heart of the question, India imported 271,000 barrels of crude from the US, from Russia in 2025. I mean, the highest they imported from Russia was in the... No, it's a moving figure, as you say, that at certain times US crude became cheaper in the past as well. WTI also went below Brent. But ballpark today, how much more would we pay if all of Russia was replaced by US and others?
But the question also will be whether US will be able to supply all that what Russia is supplying to us today. Because US is producing, let's say, the highest they produced so far was, I think, if I remember correctly, on requirement also. So that is one question, that whether they will be able to supply to India. That's one part of it. But the second part is that which type of the crude. The US also will have the sweet crudes like WTI. They will also have the sour crudes like Mars Blend, etc. That's the second part. And the economics, as I mentioned to you, will be a combination of the freight plus the price plus the type of the crude and the product value of that. So that will decide. So it will be difficult for me to say that, okay, how much generally it is cheaper. Countries are evaluating the techno-economically all the crudes. And if they are able to buy Russian crude to the extent 35%, it means that the Russian crudes are coming cheaper. And what I understand is there will be an around $2 to $3 on the end value coming cheaper to them as of today.
Okay. So if we are going to get an export advantage, we will be losing a crude advantage. Let us be very clear about that. So is it, between Putin and the US envoys succeed, then we may not be in that position. But what is your estimate of how much crude prices can rise, if Russian crude moves out?
So the question is, if there are two parts of this question. One is whether India stops buying, then what happens? That's one thing. As you already mentioned that we are buying around 2 million barrels a day from them.
Yes.
And the second thing is, if nobody buys and the Russian crude barrels goes out of the market, producer, and out of that, accounting for their own consumption, they may be exporting around 4.5 million barrels a day. If none of the Russian crude is in the market, it means that 4.5 million barrels goes out. Right now, the consumption will be, I think, around 103 million barrels a day, and total production is 105 million barrels a day. So right now, there is a surplus. But over a period, if all of the Russian crude goes out of the market, definitely it will drive up the prices. And I assume that it may make an impact of at least $10 or so. But it will lesser. And I assume that somebody will continue to buy, because the China is buying, Turkey is buying. So the Russian barrels are there in the market. So just because India doesn't buy, that is not going to say that, okay, the Russian crude inputs, the financial input they are getting will stop. So the total hypothesis on which this whole thing is...
Because the Brazilian president phoned the Indian Prime Minister, and Brazil actually figures as the 9th largest source of supply in the PPAC data. We apparently are importing 73,000 barrels per day from Brazil in the first 6 months. Is this going to be a strategic point that we build on this?
See, the question is, traditionally, Middle East had been our traditional suppliers, and they would be the larger supplier for us. So normally the sour crude comes from Middle East, and the lighter or sweeter variety were coming from African countries. Brazil has increased their production. They are almost, I think, producing around 4 million barrels a day. So that is one, definitely an input. There can be one, but no country keeps all its eggs in one basket as far as crude purchases are concerned, because there may be risk involved. There may be technical issues with the supplier. There may be issues related to logistics. There will be issues related to geopolitics. So normally all refineries will try to diversify their crude baskets and have multiple type of crude, multiple countries in their basket. So Brazil will be can be one of the supplier, including all other traditional suppliers as well, which we have, which includes Middle East countries. Saudi, Iraq, UAE had been the major suppliers out of these Middle East countries. Nigeria had been one. Libya has come into picture now. Brazil comes. Kuwait also supplies to some extent. US also has been supplying. There are also Far East countries like Azerbaijan and also had been supplying. So there are variety. India has taken crude from almost more than 40 countries. Almost 100 types of crude India has processed in the in this.
Okay, so the final question, which everybody will want to know. given the realpolitik that Russia crude cannot be forced out of the market for practical reasons, what is your estimate of crude price for the remainder part of the year? Even with a red-hot war, crude did not go above $75. That was the maximum it went. So can we rest assured that the average will be around 70 for the rest of the year?
Okay, everybody who tried to guess the crude prices has been surprised, but my understanding is that the current market is oversupplied. There is definitely demand concerns. OPEC Plus has rolled back their voluntary production cut at a more rapid rate than what was assumed earlier. So I assume that market will be oversupplied in the near future. I also believe that the complete outage of the Russian crude may not be the case because China is procuring a substantial quantity of the crude. Turkey is also procuring. So I assume that the Russian crude barrels will be there in the market. That being so, I will assume that the crude prices will hover in the range of $65 to $70. Maybe you may get the momentary spikes depending on the news flows and what tweets comes and what the statements made by different leaders of the world and how the geopolitical posturing happens. But otherwise, I believe that the sub 70 range is the most likely in the near future. But if by chance, which possibility is low, if all the Russian barrels are to go out of the market, then it will be a substantial spike. And then we can see 80 range also.
Well, I believe that's also not what the US president wants. Thank you very much, Mr. Surana, for just being the professor and providing us with a textbook to understand the Indian crude economy. Thank you very much indeed for joining us.
Thank you so much.
Well, I think all our questions, or most of our questions, are answered, but now we go back to equities.